Hello, welcome back to this week's market update. Today is Monday, March 11th, 2024. We had a very full week of economic data last week, so we'll jump right in. Looking at our market performance from last week, we saw equities slip as better than expected job gains and a higher than expected unemployment rate offered mixed signals on the state of the US job market. As of close on Friday, March 8th, we saw the S&P 500 drop about 0.3% on the week. We saw the Dow Jones drop 0.9% on the week, the Nasdaq Composite down 1.2% on the week, and then the Barclays Ag slightly up almost 0.8% on the week. Shifting gears towards our economic data of the week, I would say the largest event of last week was Friday's jobs report. So in February, we saw the US add 275,000 jobs, which was higher than the expected 194,000. However, the unemployment rate did come in higher than the anticipated 3.7%, actually came in at 3.9. So we're edging up closer to 4%, still in a very healthy range, although this was a negative surprise in the unemployment rate. And then we also saw average hourly earnings up 0.1% month over month. And I think that was also a little bit less than expected. So although we are seeing pretty decent job gains, the unemployment rate did tick up slightly and the average hourly earnings did increase at a slower rate than what economists were expecting. Another really beneficial way we like to look at the unemployment rate is the 1 year change. So that kind of shows more clear trends and how it's moving rather than just a month to month, it increased slightly, it decreased slightly, whatnot. So here we're looking at the 1 year change in unemployment over the last 5 years. So obviously, this huge increase during COVID, that was a very once in a lifetime kind of black swan event. But as you can see, since about early 2021, we have been trending upward. Now, when we look at the unemployment rate at just 3.9%, still in a very healthy range. Anything under 4% is still a quite robust labor market, according to most economists, but we are in an upward trajectory, especially after this upward surprise in last month's jobs report. So, although we still see a really low unemployment rate, we do start to see this trend up, and does it continue to go up or does it kind of just stall out? That will be a large determinant in how the US economy behaves in the next year or two. Moving along through our week, we also got the ISM manufacturing and services indexes over the last week or so. And in the ISM manufacturing index, this surprised economists to the downside. It was at 47.8% in February compared to the 49.5% that was expected, marking the 16th consecutive month of contraction in the manufacturing sector, according to this index. So, not great news there, but as we've seen in the last few months, this is right in line with the average over the last 12 months, actually slightly higher than average on a month to month basis there. But we continue to see kind of a bleaker picture of the economy from the ISM manufacturing index. When we look at the services index, it is quite different. So we'll take a look at that here. When we look at the ISM Services Index for the same month in February, that shows a different picture than the manufacturing index. So it came in slightly below expectations, but it was a very positive rating at 52.6% for February, and that's just slightly above the 12-month average as well. So anything above a 50 is considered more positive, more expansionary, while anything below a 50 is in the contractionary territory. So when we look at services, we've been in positive territory for quite a while, and that shows up in other economic data like inflation. We've seen services inflation continue to be the primary driver of inflationary pressures, even still as we approach the 2-3% inflation range, but just a very different picture of the economy when we look at services versus manufacturing. One final piece of economic data we like to take a look at is consumer credit. So it shows a great glimpse into how consumers are using credit on both a month-to-month basis, quarter-to-quarter basis, and then like a year-over-year basis. So we got some of January's data here, the first data of 2024 last week, and that showed a total increase of 4.7% in credit used, and that goes in between revolving, which are things like personal lines of credit, credit cards, the more short-term cash crunch needs, while non-revolving includes those bigger purchases like a car loan, a mortgage, student loans, more planned purchases, planned ahead of time sorts of things. So revolving increased by 7.6% from a year ago, and the non-revolving increased still quite a bit compared to where we've been over the last few months. That increased by 3.6% from a year ago. So notable increases, definitely a lot higher than December's data here, which is interesting considering that this was a holiday month there. You would think that credit card usage would be up way higher, but it is on a year-over-year basis. So it's comparing December of 2023 to December of 2022. So that kind of gives you a little bit more frame of reference of where this data is coming from, how that's pulled, and how, seasonality might impact it. So overall, we're seeing an increased use of debt by consumers, but it does lean more towards that credit card type of debt versus those large ticket items. Just interesting insights as we try to get a read on how the US economy is. So it was a little bit shorter of a week in terms of economic data, but we appreciate you tuning in and we look forward to providing another update next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.